Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm your guest, Jason Wagner, and with me, as always, is your host, Tom and Mark.
This guy's been practicing.
We said louder, but you just got more animated.
Oh, that was awesome.
That was pretty animated. Right. You're like a cartoon character. I think we referenced you as a cartoon character last time.
I'll take it.
Yeah, that's cool.
We're good.
You good with that?
I'm good with
Superhero
it.
cartoon character.
Cool.
Yeah, a good one.
Yeah.
So, man, we full disclosure, we haven't recorded in like 2 to 3 weeks.
Yes.
We were backlogged, so we stopped because we wanted things to be fresh. And then we texted like, hey, we
Oh
start
shit,
recording.
we need episodes.
It's kind of like how life flipping works. Like, just you have too many projects or not enough.
Yep.
Never just normal.
I love it. You have too much capital to deploy or nothing.
Yeah. So, man, great episode. It's so simple. Buy properties, sit on it, and you'll be good.
Yes.
You don't have to listen to any more episodes. We're
That's
good,
it.
guys.
That's it.
Simple. So, we ran a little long here. Let's just let's jump in with our housing property tip of the week. What do we got?
All right. So for our housing property tip of the week, right now we're getting into the spring season. It's raining out. Basements are backing up. And I just want to make sure, I saw a couple of landlords get in trouble for not having the flood disclosure that came out recently. So every lease in Illinois, you have to have the flood disclosure. If you have a basement, if you have if you're a garden apartment, or if you have a condo on the 40th floor, but you have storage in the basement, whatever it might be, if you have some sort of tenant access where their stuff could get ruined, you do have to do the flood disclosure. So check that out. Make sure your lease has that. If you don't have it, you can download it easy. If you need a copy of it, let me know, and I'll provide you a copy.
All right, quick question for you. Let's say I have a long-term tenant. I go to renew them this year. This flood disclosure is new. Do I just send them my typical one-page renewal, or do I need to just do a whole new lease now with the flood disclosure?
Well, you can just add the flood disclosure, but technically you probably should, because the lease does get updated every year in Chicago, and there's little things that change. And I believe there's a couple of new disclosures you need this year that you were fine up until that you renew the lease, that you now have to have that.
All right, so you guys are doing new leases.
We do new leases, new 80-page leases every single time. Whatever it might be, they're different. But the Safety Act, or
yeah, it's gotta be the first 4 pages.
That's like everyone that's renewing this year has to make sure they're putting that to the renewal.
Got it. All right, good stuff. Thanks for teaching me something. All right, our guest today, friend of the pod, been on a few times. Both Mark and I have worked with him. Started Greystone Realty over 5 years ago. He's an investor himself. Without further ado, welcome back to the Underground, Jason Wagner.
Hey, man. Hey, thank you for having me. You can't. I mean, we talked about this last time. Last time I brought sourdough. This time I brought you something you can't eat, but something you can wear. So some Greystone swag, right? So I actually brought my old Straight Up Chicago shirt, and I was kind of looking at this as like an opportunity where, like, hey, I could actually give them something in return, and they can wear it as a workout shirt.
That's my first thought, is workout shirt.
They're perfect. They're perfect workout shirts.
But my second thought is, please bring food next time.
Because actually,
I like the jersey swap.
Yeah, the jersey swap.
No, I'll take it. I'm just going forward.
I'll tell my wife. She makes great sourdough. I mean, if your wives don't make sourdough, you need
That
to
thing
get them
was
on that.
gone in one night at my house.
Yeah.
Like everyone just kind of kept ripping off a piece as the night went on, and it was gone before the night was up.
That's awesome. That's awesome.
So, all right, we are recording this beginning of May. Spring markets. So I still think it's very hot. Depending on who I talk to, people are saying, "Oh, I'm starting to see cracks. I'm having some things sitting." Like, depending on who you talk to, you're getting different opinions here. What are you seeing out there?
Yeah. Well, I think it's interesting because there's certainly a lot of noise, and that's kind of what you talk about. Actually, I just saw an Instagram post that was today, and it was like Zillow is predicting all of these markets to decline in the coming year. And I didn't even read the article, but I already know that Chicago is not on that list. There's no way it can be on that list. And we are really seeing some of the most impressive price appreciation rates in the entire country right now. And Chicago, why is that happening? It's because we have this low inventory market, and we are at like some of the lowest inventory that we've ever seen. So we always look at things on like an inventory basis as like months of supply, right? So if you didn't have new listings come to the market, how long would it take for the current inventory of homes to sell? Right now, we're at 3.1 months across the entire city. This is the lowest that we've ever been. So
what's quote unquote normal, or like an average baseline?
Yeah. So a lot of times we'll kind of dissect that, right? So anything that is 3 months and below is strong seller's market. Okay, 4 to 5 months is going to be your neutral market, and then anything above 5 to 6, 7 months is going to be into a buyer's market. And we've just been in this long period of low inventory, which
How long have we been in that 3 month range?
so ever since really COVID had hit, Okay. And so here's the thing is that over the last 3 years, we've seen very strong, steady demand. The buyers are still there. The buyers are still strong. And when I mean steady, it is like consistently steady demand. Okay. They haven't gone away, even though the high interest rates that we've had for the last 3 years. Okay. The buyers certainly declined from where they were pre-COVID and where they were at the COVID frenzy. But over the last 3 years, we've been extremely flat. But on the listing side of things, this is where we don't have that. This is where we have still a lot of sellers. They don't want to sell their properties. Okay. In the most recent stats for April 2026, we actually saw new listings drop almost 7%. Okay. They've actually been declining for the last 12 months. Okay. People don't want to be selling. And why? It's just because of this lock-in effect. They have the low interest rates. Maybe they have the property paid off altogether, but they just don't know what to do because it's hard to buy right now. It's one of the most difficult things to do is to actually purchase. So we're in the spring market right now, and literally every deal that I'm doing is in multiple bids. It's in multiple bids. It's in Tom. We sold your property in Avondale. Okay, we ended up getting multiple bids 2 times.
Yeah, multiple bids fell out. Sorry, we gotta go back to market and multiple bids again.
Yes, exactly. Yeah. Now you didn't get flooded with offers, right? We got 2. That's still multiple bids. All you need is 2 offers to be considered multiple bids. We got 2, and then we got another 2 as we went back to the market, right? And that's everything that I'm seeing is that it's still very competitive. The buyer demand is still very strong and steady. And depending on where the property is priced at, so maybe some people are saying, hey, things are sitting a little bit longer. Well, if you're not priced within the range that you should be, around fair market value, right? That's a huge piece. If you are stretching, in which I get it, right? The time to stretch is in the spring market. The spring market is really the first 5 months of the year. And that's when you can push for new pricing. And you're going to likely, be successful as long as you're within, striking range. And that striking range can sometimes be, maybe it's only $25,000, right? And you're like, hey, the property's worth $675 and maybe we'll list it at, $699, right? And we'll try to stretch. Like that makes sense of a stretch. But if the property is, $675 and you try to put it for $750, all of a sudden you might be out of that striking range and maybe you need to, price correct, right?
Well, that's the people I hear that are saying the market's not as strong. It's they had a couple, and this includes myself. I'm guilty here. You put a couple flips on the market and you get multiple offers, and all of a sudden you go to that third one or that fourth one, you push that price, maybe 25, 30 too high.
Yeah.
And all of a sudden you're like, oh man, maybe the market's not as hot. But it's not even that. It's you're greedy. That's what I was talking about
really
today about it.
Yeah. And, pricing, when it comes to pricing real estate, I always look at things in $25,000 buckets, right? And especially when you're under $1 million. When you're under $1 million, you look at things in $25,000 buckets. Okay, so big round, 500,000, 525, 550, 575, 600. Okay, those are big threshold markers. And so it's really the agent's job is to identify what is the fair market value of that property and where do you fit within that $25,000 bucket. And what I always do, I always try to be more towards the top end of that bucket. So if I think the property's worth 550, I would say we should do 550. Like if you wanted to stretch, okay, maybe we go to 575. But again, I wouldn't go 600. Right? It's just it's too much. Right? So try to be within a $25,000 bucket, positioned within the appropriate one of what you think fair market value is, and typically you're going to have a good result.
As far as buyers go, so there's a lot of flippers that are listening to this. Is it truly like you have the ability to push or flex up if you have everything brand new? I mean, what are buyers looking for in that sense when you're getting these multiple offers? Or are they okay with having to still go redo a couple of bathrooms even though everything else is good?
It really kind of depends on the area and how limited the inventory is. I think people are starting to recognize is that they can't get it all within the price bracket that they need or want to be in. And I am working with clients more specifically that are like, yeah, we're going to have to update this kitchen, but we're okay with doing that. And so I think you're actually starting to see people be a little bit more into, especially when it comes to, if you're not into the higher price, if you're in that lower price brackets, 5 to 6, depending on where you are, sometimes I'm working with clients that are in the suburbs, and we're looking in Northbrook, for example, and we're looking at $850,000 homes that need a lot of work, and they're actually okay with doing that, and the competition is very strong. But that's the price point that they need to be at, right? So it depends on location, it depends on the amount of inventory that's there, and I'm still seeing people that are actually okay with taking on work right now.
It's kind of crazy. The seller that I was talking to, that seller in Oak Park, and she's like, I don't know if I should put it on there. It's been a year. She had a whole bunch of reasons. She was talking to herself, I don't put it on there. I'm like, so I just pulled up Oak Park in the MLS, and there's like 17 properties on the market in all of Oak Park, like a major suburb. Like that's just crazy how like it was all on one page, like of the MLS. It's like
Yes.
I thought I like did the search wrong or something like that. It's just kind of crazy
Yes.
how little there is.
Well, so I was just going to say, to piggyback on that, anecdotally, like we see it too in these A neighborhoods in Chicago, where we used to call it, pre-COVID, we'd be able, if something hit the MLS that needed a ton of work, us and three guys like us would bid on it, right?
Yeah,
End buyers are gobbling that up right now.
they are.
Like the end buyers they are quote unquote settling because, hey, I need to get in this school district and this is the only way right now. And we'll defer the problem to later. We'll do a kitchen now. We'll do a bath next year, like when our bonus comes, whatever. But like we just see it. Like the end buyers are buying stuff. I almost need a foundation issue, mold, squatter. Like I need like a serious, this can't get lending type of thing to play in anything that gets listed.
Yep. Yeah, exactly. Buyers are desperate, because of how much competition there is out there right now. And, when you take kind of the step back and you look at why is Chicago seeing so much price appreciation? I mean, we're in a major metro and we are still very affordable. We are still very affordable. The median sale price here in Chicago is $389 for all property types. Okay, that's up 5% from last year. Like $389. And so there's still plenty, like when you look at that number, that is affordability. Now, obviously, when you go to where you want to live, you get priced out, right? So you just have to adjust your search. So why the Midwest is so attractive right now is because we still have plenty of affordability. It's just that the inventory is really low, right? So it's causing more people to come here. Wait, I think you guys may have introduced me, Tom, you may have introduced me to somebody that was out in California. And she came here, and I met with her for coffee, and she's like, oh my God, I can get a 3 or 4 unit in Lakeview for under like $1.5 million. She's like, that's a steal, right? And it depends on who you talk to, right? Where some people will be like, I'll never pay that, right? It's too much. Versus the perspective of a California person that's coming in and recognizing what the prices would be for a multifamily in California. She's like floored that you can find that type of property here in Chicago in a great area and you're only paying $1.5 million, right?
Well, the locals, it's damaging. I did it this morning. I went and looked at a property in Elk Grove Village, off market, and the price isn't bad, but it's like, man, it's still a little high. Now, compared to the market, it's a great deal. But I drove by a house that in 2013 I could have got for $90,000. So no matter what, it plays tricks. She's like, oh my God, am I doing the wrong thing? It's like, all right, that was 15. I had to walk myself through the justification, but you get stuck in that. You get stuck in that what you could have paid a really long time ago, and having a hard time paying whatever the 300% more. But it's just that's life, and it's a psychological thing.
Yeah. And I think right now you have a lot of people, locals, that are like, hey, this is going to crack. Like the prices continue to keep going higher. Like how many people do you talk to where it's like, oh, the prices will eventually come down? And unfortunately, when I look at the fundamentals is truly just not saying that the prices are going to come down. The only thing that I can think of where prices are going to come down is if we have AI take over everybody's jobs and now all of a sudden people can't pay their rent. You have all of that happening. But, I think we're still many years away from that type of apocalypse happening. And what we have right now is that we have strong, steady demand, even with high interest rates at the 6.5 mark. And we don't have sellers that want to list their properties. And so as we keep going on next year, as the spring market comes back again, it's going to be very competitive. It's going to be even worse. There's going to be less properties that hit the market, and there's going to be the same amount of buyers that we probably saw this past year next year, and prices are going to continue to go higher. We've been seeing price appreciations for 26 consecutive months in Chicago. Over 2 years, we've been seeing the price continue to go up and up. and averaging between 5 and 7%. So this is not telling me, there's nothing telling me in the directions of, the pure fundamentals that the prices are going to come down. I just don't see it.
Yeah, I think two important things is one, we never had that 20% boom, right? Like it's always just been 3%, 5%. Like it's been slow and steady. So we don't ride those big cycles. And if people aren't selling, we're also not building.
Yeah.
Right. You see like in Dallas and Denver and these places, like things have come down because they've been allowed to build and rents have gone down and whatever. 11 months in a row, 12 months in a row. Like it's simple supply and demand.
Last year
we have a lake to the east. We can't build anywhere else. Like
last year
people have to sell for this to work.
There's 60,000 new construction permits in Houston and 10,000 in Chicago.
Right.
And that was something that's been trending over the last 10 years, like going from 30 to 40, but we always kind of stayed right around 10. So that right there, that's the other thing that.
Well, it's interesting you bring up because I've looked at this before. Dallas Fort Worth area. Prior to 2008, Dallas Fort Worth and Chicago were basically building the same amount. Okay, and then the crash happened, and Chicago fell off a cliff, and never got back to the same run rate that Dallas was doing.
We were doing 40, 50,000 before.
Exactly.
Yeah.
Yes, you were right on. And we never got back to that. And we've been 3 or 4 times below them ever since.
Year over year, and it compounds.
Yeah, exactly.
So if you look at the chart, it's just Chicago 10,000 straight across, and then you see Houston, it goes straight up.
Yep.
Same with Dallas. I looked at them too, and Memphis.
Yep.
Or Nashville.
Yeah. So it's like why were we neck and neck with them prior to 2008, and then how come we haven't gotten back to that point? Well, a lot of factors, right? Interesting to kind of see what I think Pritzker has this whole build plan where he wants to open up the zoning a lot more. Perhaps that's going to give more incentive, but I don't know. It's not like we can build inventory overnight. So when we look at the next 1, 2, 3 years here, okay, I still see prices going higher.
Yeah,
right. It's not going to change quickly overnight. I have a hard time believing that.
We haven't talked about that on the podcast yet, but that whole build plan, it looks like it's got a lot of great things that could be super helpful. Yeah. But I feel already the amount of pushback, it's any version that's not going to pass anywhere near what it looks like as originally presented. Because these mayors are pushing back hard. So it's almost like the alderman version or the mayor version of the alderman in the suburbs with this coming out. It's going to be played with so much.
Yeah, and listen, I kind of get it, right? Like if you move somewhere, you don't want more density. Like you moved here for a reason. Like, okay, but then you can't complain. Here's a perfect example. I went to a zoning meeting in my neck of the woods because I was going to have something on the docket the next month. So I was like, I just want to feel everyone out. In between, I was talking to someone who was like against this project that's being built. And then in the same breath, she's complaining that her kid's paying $3,000 a month in rent. And she's like, it's just unfair. Like that should be like $1,500. I was like, all right, you're complaining we can't build. Yeah. And then like you pick a lane here, right? Come on, like it's one or the other, man. So like if you're gonna have that, then like you can't complain about prices being high. Like it's one or the other. Like we need to build if we want to get these things down.
But the problem you run into right now is anybody that has the power to make that change, that lady, she's financially set. Like her kind of her destiny is written for the next couple decades that she's alive, next 2, 3, whatever it is. It's our kids and our kids that are really gonna.
Yeah, we're compounding the problem. Like, because you're right, new construction now, like, oh, it's not affordable, but that becomes affordable 20 years from now.
Yes.
Like the building that was built in 1980, 1990 is affordable today.
Yes.
And we haven't done that at all. We continue not to do that, and we keep kicking the can down the road. Like, it's going to be a huge problem here. So.
Yeah. And it's the property taxes too. Like there. I wish something could happen on that front, because the biggest complaint that you get right now is that you have this big reassessment period that happens every 3 years. And because you have a strong real estate market right now, your property taxes are tied to your market values. And if those market values continue to go up, your property taxes are going to go up at literally the same rate. And that's where it gets, you feel for the homeowners. You feel for the homeowners who have been in those neighborhoods for a while. Yeah, they get to capture that great equity. Hey, wow, the house that I've lived in for the last 10 years, now it's worth, $100,000 more, $200,000 more. Fantastic. But I can't do anything with that. but now I've got a property tax bill that just went up 40%. And now I have to come up with, that out of my monthly pocket. That's where we're starting to have like, that's a crack, right? That's a crack to me where it's, the property tax piece is the fact that it's tied to real estate values and you really don't have a ton of control. Yeah, you can appeal, but I'm sorry, when there's no inventory, you can't control how fast your home value is going to go up. And because we have no inventory, strong, steady demand, you have to continue to project that your property taxes are going to go up. Actually, one of the biggest pieces where I've had a recent client came to me and he's like, hey, I bought a couple deals with a couple of other brokers before, but no one's ever actually run through the numbers with me. And I'm like, dude, this is like one of the services that I offer is like, I have a spreadsheet and it's the same spreadsheet that I use to analyze my own deals. And I help clients do that too. One of the biggest pieces that we always run into is like, what are the property taxes going to be in 3 years? And so my spreadsheet is a 5-year look. And I always have at year 3, here's what your reassessment is going to do. Run the numbers based off of what that reassessment price is. And how do I estimate that? This is a conservative way, but I just plug in, hey, if we're going to purchase it at $700,000, the property right now, they believe that the property taxes are at $400,000. Just assume 2% of that $700,000 is going to be what your reassessment is. Typically in Cook County, that's what you can get away with, 2.1. And so you're planning 3 years from now that those property taxes are going to go up. So as all investors, especially new investors, they kind of like, they scratch their heads on like, well, what do we do about the property taxes? You always have to project that, by year 3, they're going to get up. They're going to reassess you at your purchase price because more than likely right now, you're probably you're assessed too low. So
Yeah, especially the first years after purchase, right? Like same thing when we do a giant rehab, like they have the permit, everything on file, doesn't come up till the reassessed year. So you get that teaser rate for 2-3 years, and then bam. But like you need to know that it's coming.
exactly. Yeah.
So, all right. So the bottom line in all this, pricing's still very solid. Where you've been very active this spring, where are some of the neighborhoods that have been, I'll call it quote unquote good? Like where have you been seeing a lot of transactions, a lot of like these are nice pockets here.
Yeah. Yeah. I'm actually going to put, I was pretty impressed with, I had a client, same client who we were just talking about. He bought a 4-unit building in Humboldt Park, East Humboldt Park. And I was pretty impressed with the value, 1.2, 4-unit. And as he goes to execute on this, he's getting the rents. He's getting his $2,500, $2,600 rents. He's getting people lined out the door to get into his units. And everything actually ended up really, really well for him on that deal. And so Humboldt Park has been one of those areas where previously I was kind of not into it. There was still a decent amount of inventory, but I think you're starting to see all of that really, really change. So I like Humboldt Park right now.
What about when you get to the other side, west side? Like, is it strictly east? Is there a line you draw?
A little south of Grand there.
Yeah, exactly. I still draw the line there. But I think overall, the closer you are to the park, the better. So if you're a little west of the park, I think you're still going to be okay. So Humboldt is an area that I would look at.
I think it gets a bad name. It's so geographically large.
Yes.
It's so big.
Like technically, if you're at it touches like Hermosa over there.
Yeah.
And then it goes way south to almost Garfield Park, and then all the way to Logan. Like it just has such a bad name because some of it is pretty rough. But it's like, man, like
Hermosa, I like too. Like I will honestly say there's the north side of Chicago brings you a lot of good opportunities. I'm not totally like against many areas on the north side of Chicago. I like Hermosa. Hermosa is one of those areas where actually the rents are way higher than what you would think that they are, and the values are still kind of creeping up there, right? So the price to rent ratios in Hermosa seem to work really well. Okay, so I like that area. Personally, I invest in Belmont Reagan, Jefferson Park, and Portage Park. That side, and I've done well there, and I continue to push people there. If they don't know where to look, I say let's go look in these 3 areas, and more than likely it ends up kind of being the Portage Park, Jefferson Park area where they end up wanting to be. We've had some success in Albany Park. We had a client that bought a nice turnkey property in Albany Park. The success really kind of comes from a couple things right now. One is if you can put more money down, you're going to be able to get the cash flow to start to work for you. Okay. So what does that mean? Yes, it's 25%, but you might even consider putting down more than that. Okay. Well, we have clients that are putting down 40%. And the reason that they're doing that is one, they might be getting a DSCR loan, but they're also factoring in, a management fee. And so when you do put more money down, you all of a sudden can start to make the numbers work a little bit more, right?
Are you finding it necessary to qualify for the DCSR for that? Or is it just nice to have
it's a nice to have. Yeah. I don't think it's totally necessary to use that. But for example, we're working with this stretches into the single family realm. We're working with a guy who's he sold some properties that were in Colorado. He's doing 1031 exchange, and we got him into a few houses that are like out in the Crystal Lake area, so Western Burbs.
Ty,
yeah, Ty, exactly. He closes on one today, and so he's putting down 40%. He's putting down 40%, and he's buying anywhere between like $350,000 homes. Rents are anywhere between like $2,500, $2,800, and he's getting those numbers to work for him on the DSCR with management fee, and he likes that. And so like that's success, and this will be number 4 for him. Pretty incredible what he's doing. So
yeah, they're definitely
just this year.
They're definitely high quality assets.
Yeah.
And I think people like him and some other people we manage for or just talk to in general, their thought process is like, I'd rather put this money here than put it in the stock market. And mostly because a lot of people are afraid of what AI is going to do to the stock market at some point where, no matter what, the solid land is still there and the ups and downs of the market, like they either can't afford to lose it more or they just don't want to even risk it.
Mm-hmm.
So I tell them about Bitcoin. No, I'm joking.
It all comes down to what you do. If you're 25 and scraping by 5% down, just get in
5%
there.
down.
Yeah.
Get in there, get the property,
Exactly.
and get the most bang for your buck, and let the tenants pay it down, and wake up 30 years later and be like, oh, that was cool. Right?
This one in Humboldt Park, it was such a success story for this guy too, because they only put down 5%. They bought a $1.2 million building, and they only put down 5%. And here's actually a cool story about it, because he was going to partner with a guy on the building, and the partner lived in California. And we were going to do the house hack. And so he was going to live in one unit. One partner was living in one unit, and the other guy was out in California. We get the deal under contract, and we run the numbers. And believe it or not, I couldn't believe it, but we get through the hard parts of the AI of the attorney review period, and the partner's tax returns are so messed up that they actually don't qualify for the loan. And I was like, dude, we just spent all this time looking at this property. We just made it through this really hard negotiation in which we got a $50,000 credit. Like, it was a hard negotiation.
Yeah, I know what building you're talking about now.
Yeah. We got a $50,000 credit. But the success came because the house hacker, he's like, don't worry, Jason. I got a backup guy. And he's got a W-2 job. And I told him about the deal, and he's in love with it. And he's ready to, fill in, and we're going to kick the other guy out, and he's going to be the new partner. I was like, whoa. And so that was success. And the reason that happened was because the buyer on that deal, he's just networking, and he's still young. He's doing the hard work. He's doing I'm going to live in one unit, and I'm going to get the money partner that is maybe not in Chicago, but he's a friend of mine. He's very interested in buying real estate. We're going to make it happen. And so I really love that story, just because you can get creative with this stuff. I've been on the show before where I've talked about, partnering with friends of mine to buy buildings. And I think you're starting to see more of that finally, is that you're starting to see that, hey, you can partner with your agent. Hey, you can partner with your friends, and you can buy real estate. However you need to do it right now, to do it in Chicago, you need to do it, because you're missing out on this massive opportunity, which is kind of the golden age of real estate right now, where I don't foresee a dip in prices. When in other parts of the country we see dips in prices, we just see things are going higher because we are at a low inventory environment. So it's like, how do we make things happen? And so that's where you get some success, where it's like, okay, maybe I do just have to, put more money down, and that's how I'm comfortable with numbers. Or maybe I just need to partner with somebody and find multiple people to do that with, to scale my portfolio, to continue to buy in a very tough environment, which is, competitive, low inventory, high interest rates, right? So it's kind of like these creative little things.
Well, partnering with somebody, I was talking with a couple of the money side of it. Like, a good partnership is when two different people bring different benefits to the table, right? And the ability for a lot of money people to get a 5% loan down on $1 million property, that's almost impossible. And they live across the country, and they don't have that they don't have the access even to the housing stock, and their wife definitely does not want to go house hack, like any of those things. Like, to go put 5% down on $1 million building from the other guy that comes to the table that actually can qualify, willing to live anywhere, like that's a perfect relationship in that scenario. And it's just, I think people overlook that. I was talking with some of the guys, I think I referred them to you about that as well. Like that's just a perfect scenario. Or on the partner side, the other one that I think is great is you have two buddies that might be local. You partner in and you use the home, the owner occupied on one, and then you buy with one partner and you use it with the other on the other partner. You guys are just partners on paper. Like that's huge.
Yeah.
So you have $2 million in real estate total value, and you only put 5% down. That's crazy.
And that property that's $1 million is going up 5% each year for the next handful of years. When you buy
and you're capturing the 5% of the total value, even though you only owe 5% of the property.
Right.
Yes.
That's like, it's when you're not greedy with leverage and you can use it to your advantage and be smart about it. And like, it's a cheat code. Like,
I
it's
think
ridiculous.
One thing I've learned from this podcast is to think bigger. And the guys I was talking to Saturday that I referred you to,
I thought you said the one thing. I was like, come on, it was 400 something.
One of the things, but the thinking bigger piece is huge. Like, they were looking at a $150,000 house in Racine, and that to kind of gravitate because they think it's low barrier of entry. Same reason people end up on the south side, including myself at one time.
Sticked around there for 3 years.
But you do the math for with them, and you do what you just did. Like, all right, so if this goes up 10%, how much you make off 150? Then it's like, all right, if you find a 4 flat for $1 million, how much is and it goes up 10%, how much you making? Like, it's so like obvious. Like, here I am in hindsight, but a lot of people don't see that in the moment, and that's a huge part, especially if you're teaching that to your people. I've been trying to spread that word.
Yeah. It's obviously it's in the agent's interest to upsell, right? To like, oh, I'd love to sell you $1 million property versus a $250,000 property. But that's not the idea here, right? The idea here is that you are capturing so much more wealth. If the overall market is going to go up 10%, you would rather have that 10% be on a $1 million base versus a $250,000 base. And if you can qualify for the $1 million base, and a lot of people don't think that they can. And so it's kind of like, it's tackling the mindset of like, no, you probably can, dude. And here's the rents. Here's the rents of the other units. Here's how much you're going to be responsible for. Is that still within your monthly budget? Oh, yeah, actually, I could do that. Right. So it's just introducing the idea, and that's how people start to get really excited about, the opportunities that are here. So
yeah. Also, like, we talk about properties going up, like rents have done the same thing. And I'm literally just leasing up a property I've owned for 5 or 6 years now. I was just looking back at what I originally underwrote it for and what my rents are today. And I don't even raise rents on my people. It's just like at move outs and stuff. And it's like, Jesus, like, I should have bought this block. Like, I effed up. Like, when, this thing penciled at 1,700 and now we're at 2,700. And it's like, okay, like this, like it's just so, and the debt stays the same, taxes go up. So it's not pure profit, but I don't know. Time's your biggest asset.
Well, that's another valuable point too, of even if you bought that million, because you buy that $1 million property, even if it went down in value to 800,000 for whatever reason, some crazy reason or cracks we're talking about, but the rents are not going to go down 20% either. Like that's one thing that continues to go up and is, I think when we had the global crisis in 2008, rents all went up. Like, all the $750 6-flat apartment rents went to $900 within a few months. Like, so as long as you're now, back then we were buying stuff and there was no cash flow, you're actually upside down. So that screwed a lot of people. But nowadays they don't even give you the loans for that type of stuff. So even if you're close to breaking even or playing with the numbers to break even, your value goes down. That does not affect you. Your rents still go up, and you just wait till the other side of whatever that problem is.
Yeah. I think what I've also recognized is working with some clients is that, a biggest challenge for people is really your first year of ownership. And, you can plan and project as much as possible, right? But at the end of the day, there's still going to be shit that happens that
No matter what.
And you just got to push through, man. You just have to push through. And where I see, the newer investors kind of fail, or just get punched in the teeth too much, and then they throw in the towel. And you can't throw in the towel within the first 2 years. You just can't. You just got to keep pushing through, because eventually you're going to get your price appreciation and all of that stuff that you went through. By the time you hit year 3, year 4, year 5, you're probably gonna forget about it. Honestly,
And
there might be some scars.
Huge lessons too.
Yeah. But you just have to push through your first 1 or 2 years. And I think where I've seen some people that I wish they had a little bit better results is that they got out too early. Actually, I saw Grant Cardone say something, which was, why, the biggest thing for investors right now is like selling too early. And selling too early. There's a moment where you sell, and a lot of times it ends up being too early for people. So to your point, which is time is your asset. Like, continue to let that thing ride. Remember the long term. This is why I run things. Whenever I work with a client, we always run things on a 5-year perspective. Like, you are keeping this property for 5 years. And at that point, you can start to make a decision on it.
My worst properties in 2010 are my best properties now in 2026.
Yeah. Yeah.
No, it makes sense.
That's all.
It makes sense, right?
Quote ended.
It totally makes sense. Yeah.
All right. You brought the Wagner report here with us. What
Yeah.
do we got? Anything, any key statistics you want to share with us?
Yeah. Like, have you guys? I don't know. Like, this is a really cool report, and I'm really excited about this too.
How can people sign up for it before we forget that?
Yeah, I knew you were going to ask me that, right? Okay, so what I want you to do, I want you to follow me on social media, on Instagram, Jason Wagner _real estate, and go to my link in bio and sign up for the report there. Okay. First off, I want you to follow me on social media because I post stuff constantly about real estate. But get on this report. And what's really cool is that we're finally rolling out something where it's not just going to be a Chicago-based report. Because right now what this is overall Chicago market. And then I give you some really great stats about the neighborhoods and whatnot. But sometimes when I send this to somebody who is, dude, I don't care about Chicago. I don't care about the condo market, because I have stuff in there that's on condos, 2 to 4 units, single family homes. I only care about Jefferson Park. Give me Jefferson Park and where that is. We're now finally going to get you reports specific to the neighborhoods that you care about. So when you go to sign up, you can actually select, hey, I care about the Wagner report, which is going to be Chicago. Select that one. But then you could also say, I want Jefferson Park, I want Portage Park, and I want Belmont-Cragen. And you're going to be getting individual reports sent to you on a monthly basis now. Hopefully automated. That's what we're rolling out, which is going to be really cool. And so we can, not only do we have that for the Chicago neighborhoods, but we're going to have that for the suburbs as well. So for example, I've sent this report to my dad. He lives in Elgin. He's like, dude, this looks really cool, but it makes no sense to me because the Elgin market is very different than what the Chicago market is. I'm like, yeah, I should be sending you Elgin. And so now we have that capability. So I've been developing this thing over the last couple of years, and so I'm really excited. It's going to be a beta version, but overall, it's going to provide a ton of value to people. And what's really cool is that if you're also a real estate professional, is that you can. We're going to try to monetize this a little bit, but you can actually be it could be the Ainley report, right? It could be it could be cool. So you can actually put your brand and your stuff on it as well, and you could use this stuff. And so ideally what we're trying to do, what I'm looking at is trying to be a little bit more of a competitive advantage of why Greystone is really cool, but how we can also help other real estate professionals and maybe other lenders and whatnot, is that you can put your own branding on a report that you do nothing for, and then you could send it to people that actually care about those neighborhoods. And so that's a big thing that I'm working on in the background. I'm really excited about it. But this is the report, man. So it's all right. So I think what most people kind of care about is I do a top 10. I do a top 10 analysis of hey, here are the 2 to 4 units that have been appreciating on the north side of Chicago for April of 2026. Okay.
And
so
when you're saying like they're up X%, what
They're
are you comparing it to?
I'm comparing it to prior year.
So April
how
2025.
much, so just like how a stock goes up, Tesla is up 2, 3, 10%, right? So you can look at that on the neighborhood basis too. How much the median sale price of a 2 to 4 unit on the north side of Chicago are. Here's the top 10 in terms of percentage base increases from year over year. Okay. So your number 10. North Park is sitting at 656,000. That's up 13%. Okay, number 9.
The median of all 2 to 4
The
sales.
median of the median of 2 to 4 sales. Okay. Number 9 is West Town. 905, it's up 13%. Okay. Number 8, Austin, which is 396,000 median sale price. It's up 15% as well. Number 7 is Logan Square, 833,000 for a 2 to 4 unit.
And my 1.7 million two units skewed that.
Yeah, you know, sometimes you get that, right? This is the median. So what makes it the median, right? You're going to have those big ranges. Yours, what you just talked about. You're going to have some smaller ones, right? The median is right in the middle of that range, of that price range.
Yeah, this is not the mean. Like
It's not average.
It's not average. It's not
I
average.
remember mean, median, mode. Right?
Yeah.
That's right. Yeah, going back to 6th grade math. Yeah.
Just helped my daughter with that the other night.
Yep.
Number 6, Edgewater, 980. That's up 15%. Like these are big numbers. Again, this is what we're talking about. Edgewater, 980,000. Like again, $1 million multifamily, up 15% from prior year. These are big numbers. This is where you can get, some really nice wealth growth. All right, number 5, Lincoln Square, 914, median sale price, up 16%. Number 4, North Center, 963, up 17% from prior year. Number 3, Avondale, 700,000 now. They just ticked over 700, up 17%. Number 2, West Garfield Park, 368, up 17%. And then number 1, East Garfield Park, 491 is the median sale price, and that's up 32%.
Would not have guessed the West Garfield Park.
Yeah. Would not have guessed.
People
the
are getting
West Garfield
adventurous.
Park. I had to double check the numbers, and they're all. So all of this data comes from, just so you know, all the data comes from the local MLS, which is MRED, that we use here, and they use, there's a program called InfoSparks. So every month, I'm able to scrape all the data from InfoSparks, and we have a giant Excel file, and that's how we can put all these rankings out there. And so I think people find a lot of interest in, where are the neighborhoods that are going up, and a lot again, on the 2 to 4 basis in all of Chicago, overall, the whole city is up 10%. So when you see double-digit numbers like this, this is the 2 to 4 unit space has actually been appreciating way better than single-family homes and condos right now. So that's pretty cool. You said rent growth. I think this might be interesting for some people. North Side. I do another analysis. If you guys are familiar with the website rentometer.com, I actually think it's pretty good. I think Rentometer is a good place where you can go get an average. You don't necessarily, maybe don't know the neighborhood or, the suburb, for example, and you can put it in there and it'll give you a pretty good ballpark. So I like using Rentometer. And so every month
I call it rental meter.
Actually,
At first I'm like, what?
Well, it has a hyphen before the O. It might be.
We're talking about the same thing.
we are literally talking about the same thing. Tomato.
I'm like, what's he talking about? Oh,
Yeah.
wait, we're talking about the same thing.
Rentometer. Okay, maybe it's Rentometer, maybe it's Rentometer.
Whatever, you're probably right.
Okay, so every month I'll have my VA go out and scrape every single neighborhood that is, and we'll record where the rents are. And so the rent growth in some of these neighborhoods, here's the top 10. Okay, so starting with number 10. So West Town is up 7.3%, and the average rent, $22.47. Okay, so how I want to just describe this a little bit, how I actually get to the average rent. So we'll go in Rentometer and we'll pull the average 1-bedroom, the average 2-bedroom, the average 3-bedroom, and then we'll average them together to get an average for the neighborhood. Okay, and
so by doing it this way, you're not skewed by having more 3 beds than one. You're taking
we're taking
the average of each.
The average of each, and then we come up with that's the average rent. and then we compare that number to where we were at this point last year.
Okay, makes sense.
Right. So Westtown is actually up 7%, 7.3% from prior year on the rent side. So that's number 10. Albany Park up 8.3%. Okay, 1823 is the average rent there. Lincoln Park is up 8.7%. 2933 is your average rent there. Okay. Austin up 9.2%. Average rent 1367. Jefferson Park up 9.4%. Average rent there 1778. Lincoln Square is up 13.6%. 2324 is the average rent there. North Lawndale 18%, 18.1%, the average rent 1575. Dunning up 19.5%. The average rent 1754. Avondale up 20% on the rent, which is 2046 is your average rent. And then West Garfield Park up 22%, and that's at 1525. So to me, we do all this work for you, and to be able to see the rent growth, to be able to see the price growth, you all of a sudden you put all these numbers together and you're like, all right, wow, it's a really good rosy picture. And now I can start to identify where are the neighborhoods that I want to focus in on. And when you see good numbers, that makes me want to go check out. Should I go check out West Garfield Park? Let's go check it out. Let's go see what it's like. Should I go invest there, right? And then you go and do your due diligence, and you get in the neighborhood, and you're like, yeah, this is for me, or yeah, it's not, right? So that's why we like to advertise. Here's what the numbers are. Now you guys go find it, right? And go look at these neighborhoods and see if that's an area that you want to invest in.
Yeah. So. Man, if you showed anyone those rents from 5-6 years ago, they'd be like, you're crazy.
Yeah.
Right. It's nuts how things have skyrocketed.
Yeah.
What, looking back, because you've been, how long has Greystone been in business now?
Yeah. So we actually opened in 2021. And so we're on 5 years now. And, what makes us kind of unique is that we require the agents that hang their license with us to be investors themselves. And so I like to say, we play the game at the highest level, which is we're actually out there, we're actually buying buildings, we're actually partnering, we're actually rehabbing, we're not full-time rehabbers. We still sell to traditional people, but we also work with a number of investors. And again, I think that hands-on experience and all the nuances that kind of come with investing in Chicago real estate, you don't learn that stuff unless you're actually out there doing it. And that's one of our biggest competitive advantages, I would say, is that we're actually in the game playing, and I can tell you all kinds of scenarios. Right? I finally went through my first eviction this last year, and it took me 10 months, but it was one of those things where it was like, I had a number of clients that would come to me and be like, well, what would I do with an eviction? And I was like, oh shit, I don't really know because I haven't gone through it yet. Well, I finally had my first opportunity.
That's why you start on the south side.
Yeah, way faster.
You get into it early. Yeah, you get it into it early.
So looking back though, what would you have, knowing what you know now, going back to 2021 Jason, 5 years ago, what would you do differently?
As an investor?
Yeah.
So,
or I could rephrase the question. What would you tell people back then that you're telling them now?
Yeah,
either investor or help an investor.
Yeah, I think I recognize that. It has to be the multifamily. You have to focus on the multifamily, and in my opinion, I think a lot of people will still focus on hey, how do I add value? Where's the value add? Well, you can also remember that value add comes from just raising the rents, and there's still buildings out there that are, a lot of the work has been done for you, and because of the rent growth that has occurred, your value add is just getting new tenants that are going to pay more, right? It doesn't always have to be this huge rehab. And so I like to, honestly, a lot of the clients that I work with, we're not necessarily buying, very distressed buildings. We're buying more turnkey. Maybe there's a unit that they need to update, right? Or there's some pieces here. The value add often may be, hey, we're renovating the basement unit. Very manageable stuff. But we're still buying a mostly turnkey. We have a plan. Here's the value add. It's it's boiler. It's a boiler building. How do we convert that into furnaces? Those are the types of discussions that I'm having, which is you have one main boiler. Well, let's get that off the landlord expense and let's put in individual furnaces, plan $10,000 a piece per unit. And all of a sudden that is more of a value add. Now you have central AC. Now you can charge more in the rent. And you're going to have a building that's going to be worth more because you went through and converted that. Right. So a lot of times those are the types of things that we're talking about in terms of the value add for the clients that I'm working with. It's like, all right, maybe we're renovating that basement unit. Maybe we're doing the infrastructure update of, getting rid of the boiler, making it furnaces and AC. So things like that.
Yep. You already shared some of the stats. If someone came down and said, hey, here's $5 million, go invest in Chicago or Chicagoland area, what would you do with it?
Well, it depends on how risky they want to be. In my opinion, I would, if we could buy cash, I would be buying, I'd be buying Lakeview. I would be buying very desirable areas. And because I think that these Class A neighborhoods are going to continue to go higher. And, again, when you think about the overall Chicago market and what you can get, if I could buy cash in those areas, I would totally do it. I think that the risk is low, the quality is high, your tenant mix is going to be really solid, and I think overall you're going to have a very great experience. Yeah, that's what I would do.
That's what we see. Like we see people coming in from Asia or Europe or whatever, and just buying cash there and just parking money, right?
Yep.
Like it's what people who have money do.
Yeah.
All right. I'll rephrase the question a little bit now. What are some neighborhoods that probably aren't quite there yet that you think are going to have like the biggest upside?
Yeah, biggest upside. I think it's that Humboldt Park area. It seems to be where, Humboldt Park, again, it touches so many different areas, as Logan Square starts to get more expensive, as West Town continues to get more expensive, right? The natural progression there is like, they go further west. And so I think the Humboldt Park area is bound to continue to do really well. So I like it.
Cool. All right, and then for suburbanites like yourself, give us a suburb that you're bullish on. Can't say Arlington Heights.
Oh man, I have to. Okay, so the North Shore. Holy cow! Like it is actually incredible to see how much the values of very expensive real estate are going up by, and we are. If I could afford it, I would be buying in the North Shore. Because you have, for example, I'm actually selling my cousin's house. They bought it 10 years ago at 1.6, and we are on the market at 2.5 under contract. And, he's essentially going to gain, over $1 million or very close to it in a 10-year period. And most of that growth came within the last 5 years. So the North Shore area has been incredibly impressive in terms of the dollars that are going there, right? I think what we've seen right now is that inflationary environment is that the rich got richer, and you're seeing the real estate values of the rich people going up.
Yeah,
so,
you see I call it the FU money. We see it even in Chicago. Like, someone just comes by as a $2 million home cash. It's like, what's going on?
I actually want to bring that up because if we talk about single family homes, like look at what's happening here in Lincoln Park. This is the number one on the north side. So 2.4 million is the median sale price in Lincoln Park. And that's up 32% from prior year. Like that is ridiculous. Let's go to Lincoln Square is another one here. I think you do business in Lincoln Square. Okay, 1.2 is the median sale price. That's up 26%. It's to your point. It's the FU money is really showing. North Center, 1.7 is the median sale price. That's up 11%. Right, and so it's the people that have money are willing to pay more for very quality real estate, and we're seeing that in the numbers.
Yeah, I was talking one of the Renovo events, talking to someone who does new construction out in like Wilmette, Winnetka, and I was like, so how do you price it in the back end? Because the lots are all different. He goes, man, you just build it, see what number you need to get, and you list it for that. and someone comes and buys it. Don't overcomplicate it. I was like,
Yeah.
oh,
Yeah.
good luck to you, sir.
Yeah.
Bold strategy.
Yeah.
But like, he's kind of not wrong. So, all right. Before we wrap here, outlook on Chicago.
We are in the golden age right now, and in my opinion, you need to do everything you can to be buying real estate, to buy it quickly. Don't let fear of the market hold you back, because I think those are very valuable things. Time is kind of working against you right now for a lot of people. People are getting priced out. So how to come up with scenarios on how you can make it happen, and it's having these conversations with other people, like-minded people, and do everything possible. Have a saving plan. Look, we got to save this much. We only need 5%, right? For most easy deals, you only need 5% if you're going to live there. Have a saving plan, and really put that into play. Do everything you can to buy something now, because I guarantee you, if you wait another year, you're going to be paying another 5%. You might be paying another 10% more. Right. And so time's not on your side from that perspective. So I'm very bullish. I don't know. Could be wrong. Could totally be wrong. Anything could happen. But, in my opinion, I'm still, I want to buy another property this year. And it's been always in my plan where it's buy one property for 10 years straight. And I think you're going to be just fine. I'm on year 7 or 8 of doing that. And, it's a very reasonable, manageable plan that I think that a lot of people can actually do if they were to put it on their vision board.
Yep. Awesome. Good stuff. Ready to wrap?
Yep.
Let's do it.
All right, man. What's your competitive advantage?
Man, we're out there. We're out there doing it. We manage our own, and you're probably going to be like, why the hell are you managing your own properties? But we manage our own properties, and it's like, you get that hands-on experience, and eventually I'm not going to manage my own properties, just so you know. But yeah, actually out there playing the game, right? And so being able to offer this, real life tangible advice that's the advantage.
Yep. All right. What's the one piece of advice you would tell someone that is yet to buy their first property here in Chicago?
Okay. Yeah. You got to do it, man. You just, go to the networking events, because I think that's probably the biggest piece. If you don't know where to start, go to the networking events. You're going to meet great guys like you, like yourselves. You meet anyone there that are going to be ambitious. And then one thing leads to another. The very first guy that I ever met was RJ De Leon, and I still talk to him. And he was at the first networking event I ever went to, and it's just kind of funny how all that works out. So,
all right, what do you do for fun these days?
So
if you have hard?
Yep, I did do it this year. I did. It's funny that you say it's hard, or that it's fun. I did do it this year. Yeah, so I start 75 hard. I've been doing it. Let's see, this was the 4th year of completion, and I try to do it at the beginning of the year. Kind of kickstart the year. So 75 hard, if you're not familiar, it's it's 2 workouts a day. Both of them have to be 45 minutes long. One of them outside. You drink a gallon of water. You read a nonfiction book, 10 pages. You follow a diet. You can't have any alcohol or cheat meals. And you have to take a selfie. So you do all that stuff. And so this year, I did that, but then I also added a little bit of flair to it too, because I was like, okay, I've done it 3 times. I'm pretty confident I can do it again. But I made a Instagram video of a real estate tip. And I did that for 75 days. And actually, I ended up failing on day 9, so I had to restart. So I did 84 days of real estate tip videos while I was doing 75 hard. And actually, that was a lot of fun. And part of the reason why I have the Greystone shirts was if I'm going to be on camera every single day, I should just be wearing a Greystone shirt.
You should just get it tatted.
Yeah. Shirts off with a tat, dude.
Yeah,
for sure, man. It's way cooler.
And so I bought a shit ton of Greystone Realty shirts that are all different colors. And yeah, so that's why I have so many, and I wear them daily now. But yeah, that's the fun part. But in reality, the fun part is, it's chasing the freedom, man. It's I got a family. I got 3 kids at home. Playing with them. We just opened up our pool today. That's fun, And, we also do some really crazy things where it's like we started homeschooling our kids. I talked about this on the last show. We started homeschooling our kids. So we did a 1 year of that this year. We realized that we want to do more of that. And it's like everybody is in real estate because they want the financial freedom. But what does freedom kind of look like to you? To me and my wife, it looks like, if we could just go travel at any time we wanted, we didn't have to worry about school. Like that's freedom to us, right? If, my wife has, big dreams of being a professional cheerleader, and she's going to continue to pursue that, having the opportunity to provide that to her. And if she makes a team in another city, like, hey, could we actually pick up our family and move there and like actually play out that dream of yours, right? That's freedom to us. So we have these conversations all the time, and it's like, how could we continue to do these really cool, fun things that the only reason that we have this opportunity is because of real estate. And it's because of Chicago real estate, right?
Yep.
So,
All right. So give us a good book, podcast, or self-development activity you'd recommend to our listeners.
Recently read Grant Cardone's 10X. I think that's great. I think that's a great book. Basically, he just says, like, say yes to everything. Say yes to everything. You just keep going. If you want to keep growing, just say yes to every opportunity that kind of comes your way, and eventually the numbers are going to work out in your favor. So
cool. Other than yourself, name a valuable resource for other Chicago real estate investors.
Obviously you guys. Obviously, can't say that though. I would say RJ. I already mentioned him. He's fantastic, man. He's one of the OGs that I ever met. RJ De Leon is great. But I actually want to say Eric Workman is really awesome. I've really developed kind of a relationship with him, with Renovo. I wish we did more business together. But he's kind of a cool guy. We follow each other on Instagram. What I've noticed, like when you go to these networking events and you meet these guys, it takes a little bit of time for the relationship to kind of develop. But over time, like 3-4 years, like it starts to get really warm, and there's a lot of opportunities that start to come. But you have to give it time. You can't go into a networking event and think that, right away you're going to get somebody. I think those relationships need to foster, and I think you'll start to see the benefits of those, after 3-5 years of, being in the same room with these guys. So anyways, Eric Workman is really awesome. Love him. And also I need to put this, Wonderful Tugby. Has he's been on the show before?
Oh, yeah.
Wonderful.
Yeah.
Dude, he puts out some great content.
He does.
He
And
puts
sometimes
out,
he's wearing a podcast shirt too.
oh
so
my God. Yeah. He puts out some great content.
Talk about saying yes to anything. Like that guy just figures it out.
Yeah.
Yeah, he does. He does. And praise him, man. He's awesome. Great guy. I love the guys that are just transparent. He gives you the ups and the downs, and he's just been successful. And
his first name's Wonderful. You just can't be a dick with that name. Like you just have to be like good and successful. Like,
I don't usually click on anything, but if I see something like from him where it's like, this is how I lost $50,000 on this, it's like, oh, let's see how he did that.
Yep. Yeah,
All right,
great, man.
Jason, thank you so much. You provided a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
I would say, so you can always reach out. My cell is 847-997-1639. You can email me, jwagner@greystonerealtychicago.com. Find me on Instagram, JasonWagner_real-estate. But I would also say, like, I'm looking for people that are, might be interested in joining our firm. Okay. I would love to have another 1 or maybe 2 agents that are actively investing, but also want to get into the sales. And, it's helping investors, but also at the same time helping traditional buyers and sellers, because that's a big market too. It's a really big market. And look, you can have a fantastic career. Like, my retirement plan is real estate. My retirement plan is real estate. If I buy 1 property per year for 10 years straight, I'm going to be just fine. And I think that type of mindset of an agent is really, really cool. And we'd love to have others that kind of think the same way. So if you're interested in ever having a conversation about, being a part of our firm, I would welcome that. So.
All right, good stuff. We'll link to that in the show notes. let's wrap with our Chicago fact. Mark, who we playing for? Who's sponsoring?
Well, our sponsor today is Greystone Realty.
Hey, awesome. Let's go.
And we're playing for Shelly Broderick. So, Shelly, if myself or Jason gets this question right, you get a $50 gift card brought to you by Greystone Realty.
I wanted to name one of my daughters Shelly. My wife would shut that down. Shelly Shellcross. All right. Chicago's 77 communities. Which one, and you're going to have multiple choice, which one is the most populous with over 105,000 residents? So not like per capita, just the one that has the most people in it. And your options are the near north side, Austin, Lakeview, South Shore.
I'm going to go with Lakeview. I would say second, South Shore.
Oh boy, I was gonna say the near north side because there's so many condos.
Maybe that's what you go with. I'm not saying I'm wrong.
But yeah, I'm gonna go with near north side. Yeah.
Near north side. Way to bail them out. All right. The density, baby.
Do you have the actual numbers of how many for those four?
No, I just Googled what was the number one.
Yeah.
How many people are in it?
105,000.
5,000. That's
Wow.
crazy.
It's pretty big, though, because it goes all the way to North Avenue. The boundary is North Avenue, and then the lake and the river and the river. Like the river curves. Like it goes pretty far.
I mean, there's just so much density.
It's just, it's 300 units, 800 units.
Yeah.
And it's not like a tiny area.
yeah.
You know what's crazy? The suburb that is way huge, way bigger than I ever thought. Cicero. Cicero has 80,000 people.
Whoa.
Like you, I would never.
Wow.
I never
I feel
thought.
like that was a Chicago fact like 500 episodes ago.
I don't know.
with John
I
Wagner.
thought I learned it on my own, but maybe you taught me. I don't know.
80,000 people.
All right, Shelly. Well, Jason, he
Let's
earned
go,
the right
Shelly.
to get you a $50 gift card brought to you
Amazing.
Way to
by
charge your
Greystone
gig. You
Realty.
Cost yourself 50 bones.
Let's go.
All right. Well, Jason, thanks for coming on. Tom, thanks for coming on. Listeners, we talked about it here today. Networking is key. Get out there. Go to straightupchicagoinvestor.com. We have a list of all the networking groups, and they're hitting hard coming this spring, this summer. Get out there. It's nice. A lot of outdoor type networking going on. So check that out. straightupchicagoinvestor.com. Jason, thank you. Tom, thank you. Listeners, we'll see you next week.
Thanks all.